So what can you do about the higher mortgage interest rates? My name is David Giles, otherwise known as the Property Guy. Okay, so what can you do to overcome these higher mortgage interest rates? Perhaps you're already feeling the pain now. Maybe you're anxious about future payments when your current mortgage, comes off its fixed product. But when you're feeling worried, it's often quite hard to think clearly and be more decisive. So what I thought I would do is make a list of property related ideas on how you can increase your income and reduce your expenses. But I must say that not all of these ideas are going to work for everybody. Everybody's personal circumstances are different. So always feel free to drop me a message on here or send me an email for your specific circumstances. But on that note, this is a disclaimer alert. I'm not a mortgage broker or a financial advisor of any kind. So I'm not regulated or qualified to give you any financial advice. So anything I do say is based on my personal experiences, on what I've learnt as someone that's highly obsessive in learning everything about my own trade, which is estate agency and property investment and development, and all the interconnecting sectors that surround it, be that financial, legal, tax, planning, lettings, management, and all manner of property investment strategies. Okay, so number one, speak to your current mortgage lender. Now, I think always the first step should be to discuss the options available to you with your mortgage lender, because they may be able to offer you some temporary payment arrangements during a difficult time. For example, in the past, some lenders have been willing to switch your capital repayment mortgage to an interest-only mortgage. I mean, if you've got some savings, you could consider paying down some of the loan to improve the interest rate. Now, there's something called LTV, which stands for loan to value, and it's something that mortgage lenders assess to determine what rate they're willing to offer you. And typically, the way it works is the lower the loan against the equity value, then the better the interest rate will be. And the higher the loan is to the value of your property, the higher the rate will be. Quick example for you: if your property is worth £100,000 and your mortgage loan is £90,000, this means you have a 90% loan to value. Purely as an example, let's just say that the mortgage company were happy to offer you a 6% rate when you were at 90% LTV. Let's say you have £10,000 in savings that you'd be willing to pay down the mortgage to bring that mortgage down to £80,000. In that instance, your new loan to value will be 80%. So 80% loan, 20% equity. Now, it might be that that lender has a drop in their interest rates. Let's just say 5% as an example, when you hit that 80% loan to value threshold. So now, instead of paying 6% on £90,000 loan, you're now paying 5% on an £80,000 loan. As I say, it's only an example, but that would save you £117 a month, basically by reducing the mortgage interest payments from £450 a month to £333 a month. But perhaps you don't have £10,000 or enough in savings to pay down your mortgage to actually get to that next LTV threshold to get the rate down. But maybe you've got family or friends that would be willing to lend you some money for the time being to do that. So over the next few months or years, as market conditions improve and say the property value gets higher, and actually over the course and passage of time improves the loan to value without having to pay any more money into it, therefore allowing you at some point in the future, when things are better, to refinance again and extract that money that friends or family were willing to pay and help you at that time, so you can pay them back. It's just an idea. Okay, idea number 2.